All right, so very good morning to all my friends, those who are sitting in the classroom or also following through Zoom. Today we have a SPSS session, and this session would be in two parts. So the first workshop will be conducted today, and the second one will be next week. So I have some ambitious plans that at least we should go to certain extent inferential statistics today, but I'll explain it later. Maybe all of you, if you can please go to, if you can sign in and you can start searching by using keywords SPSS in your computers. So if you kindly type in, I hope you can see my screen. So if you, for example, type in SPSS, you will find something like this, IBM. No, wait a sec, let me share my screen first. So if you type in here, SPSS, then you will find IBM statistics. I have an updated version on my computer 27. Hopefully you will also find the same. But as long as you find SPSS and something, yeah, something like this. And if you get this type of dialog box, you can cancel it. So in principle, we want this empty spreadsheet, something like, it looks like Excel, but you can see the layout is different. It might take some time, so don't lose patience. So, but eventually it would show up on SPSS, I mean, in your computer, so I think. The students who are following online, I think you can also do through remote. If you try remote.yamk.fi, and then after you go there, then you can type in SPSS and you will find it out for sure.
Yeah, I have it open.
Sorry?
I have it open.
You have it?
Yes.
Excellent. So I can wait till all of you are having this empty spreadsheet. If you all have, then we can carry on. Yeah, thank you very much. Remote.yamk.fi, Stefan. And then once you are there, you can type in, by searching, you can go to SPSS. So it's not a big deal. Can you guys confirm if you haven't got it? You can type in your message if you haven't got it yet.
Yeah, I'm opening it.
You're opening it? Okay. When you're done, then let me know, because I want to wait for you till you reach at that stage. Because I know many people are following online, so I don't want to leave anybody behind.
Okay.
So, folks, by the time you are opening up SPSS workspace, I want to share the spreadsheet, the data, which we all will work together. Okay? Because it's a workshop, so I want that all of us, we work together. But I haven't shared the data yet with you. And by the time you guys are opening up this workspace, I would share my Excel with you in Moodle. So you might have to go to Moodle as well. See, you guys can see that in Moodle, there is a, in the course material folder, link rather, there is a folder of spreadsheets. So this is where I'm going to add the data, which will be working together, just in case you are not able to find it. But spreadsheets, where is the editing thing, by the way? Ah, it's here actually. And here I can bring in the file. Choose file from Okay. So first I close this. Right. So now I upload this file with you, and you will find it that if you refresh your Moodle workspace, you will find that this research methods SPSS session data file is now available in Moodle. And now I assume that we all are having this Moodle file, Moodle workspace visible. If you haven't, please let me know. All right. So and you guys can keep a check that if the screen is visible to.
It is.
Okay, good. So just in case you find it's not visible, let me know, because I might be too much carried away by my. Okay. So this is the Excel, which you can also access now in Moodle. And what I'm going to do is, if you look at the SPSS view, you will find that there's a data view and the variable view, right? Can you see that? Here, we write the qualities of the variable, and this is the data. But anyways, what I'm going to do is, I'm going to copy the entire of my spreadsheet, which I shared with you, the whole of spreadsheet. But before I share this spreadsheet with you, I want to show it. I have the variables. My first variable is free cash flow. Free cash flow, we discussed last week while doing valuation topic, that this shows the available resources with the company. And this is a sign of firm's future growth. A company with more free cash flow is more resourceful to make some innovation and R&D in the future. And then we have the total revenue. And then we have the natural log of total revenue. The reason is that if I only take the total revenue, then I would assume that the big firms would have a bias, because the big firms, they have more revenue, but that doesn't mean that they're more efficient. Do you get my point? The big companies have larger total revenue than the smaller companies, but that doesn't mean that the big companies are efficient in comparison to their smaller counterparts. So there is some kind of size effect in favor of the big companies. Now we have to discount this size effect and try to make it neutral. We need to make it neutral. Okay. So what I do, I take the logarithmic values, which you can see here, perhaps, that I put the log values. The reason of taking the logarithmic value is that this makes our data non-linear, which is what we want. Because if the data is overly linear, then why do we perform these operations? Then no secret is hidden. The non-linearity of the data is something that we want to explore, because that's where the secret lies. If something is too predictable, if you see the last 500 games of a club, and in the last 500 matches, they have been scoring 3 goals every match, not even 2, not even 4, 3 matches, then all else being equal, you can say that on 501st match, they will score 3 goals again. So then what are we exploring by the way? So nothing is secret then. So this non-linearity is very important. That's why if you take those absolute variables, then you prefer to make them non-linear. There are many ways to make them non-linear. One of them is to take the logarithmic values. And then we have the operating returns on profit, return on capital employed, so on and so forth. And then I have different colored variable, which are about the stock return of the company. And you can see that I took various forms of stock return. I took annual stock return, then logarithmic stock return. So different forms, but that's not a problem. And then we also have the exponential stock return. So the point I'm trying to make here is that sometimes you have to change the form of the variable. The variable as such doesn't work, so you need to change the form, but we will come to this point later on. But can you see that I have different colored variables in my Excel? Some are black, some are red, some are green, then there is a one purple and one blue, sky blue, or maybe, yeah, which color? I'm a bit colorblind, so I can't make up. Do you know why I did it? Because I want to give you a suggestion that when you are doing your thesis and you have lots of data, always try to group the data, try to label the data so that the similar variables are together in the Excel. So if you see all the black colored variable, they all come from, the data comes from your financial statements. So you can see that free cash flow, revenue, capital employed, so or calculation based on them. They all come from your annual report or the data from the annual report based calculations. If you see the red ones, they all are coming from the stock market, like Yahoo Finance or Bloomberg or NASDAQ, yeah? And if you look at the green data, they are showing your corporate governance variables, the board size, education of directors, experience of directors. So that is talking about the directors, people's characteristics, the leadership, the firm leadership characteristics. So I put them together, and then I have a growth I have a corporate finance variable, capital structure variable, debt to equity. It shows that for the company financing, how much is coming from debt and how much is coming from equity. Okay, so debt and equity. And then there's one more variable called innovativeness. Innovativeness means how innovative the company is. Some companies are more innovative, some are less innovative. Now, if you see this innovativeness variable in particular, you'll find that there are ones and zeros. There is a reason for that. You can measure a variable in many ways. If I ask you, how do you measure the welfare of the resident of Uvascula? You can say that the one variable could be that how many doctors we have for 1,000 of population. So the intensity of doctors per 1,000 population is a good variable of welfare. Somebody would say, no, we don't go to doctor every day, but our kids go to school every day. Let's use number of teacher per 100 kids. Somebody would say, no, you have to differentiate, because not everybody, kids become more grown up when they are doing secondary education, but kids need more social welfare and care at the primary studies. So don't include all teachers, only include the primary teacher per 1,000 or per 100 population. Somebody would say, no, these days movement is very important. Let's see the welfare by how many buses we have in the city for per 1,000 of population. Then somebody would say, no. These days, communication is more than the physical transportation. See how many, what is the internet intensity, or let's see how many breakdowns of internet have occurred in Uvascula in the last 1 year. More occurrence of disturbances means lesser quality of communication. And then somebody else comes and he says, no, you know what, life security is very important. See how many crimes have occurred in the last 1 year in Uvascula, which means more crimes means lesser welfare. So do you get my point? There are different ways to approximate a variable. That is why sometimes we call them as proxies. Proxy. rather than, means they're not exact measure of a phenomenon, but they are only approximates of that phenomenon. The phenomenon which I gave you an example was welfare in US. And we had, I think, about 10 plus, there can be many more proxies of it. Same way, you can measure innovativeness of a company by many ways. You can see how many products they have invented in the last 5 years. You can say how much amount they spend on R&D, how much intellectual capital, the intangible assets they have. But you can also, but all these numbers which I'm saying so far are called quantitative variables. But there's one more category of variable called categorical variables or binary variables, or sometimes you also call them dichotomous variable, dichotomy. We have dichotomy in our life to do or not to do something. Turn right, turn left. Yeah. Dichotomy variable or dichotomous variable are basically symbolized by 1 and 0. If a phenomenon exists, you call it 1. If a phenomenon doesn't exist, you call it 0. For example, if you want to include gender in your, let's say you want to talk about the companies who give better stock market performance, and you want to say that, and you want to study, do the companies whose CEO is a female perform better in the stock market? But the question is that your main variable is gender of the CEO, and you can also always show the gender. How would you show the gender as a measure of in quantitative terms? Because gender is a quality, right? Then you can put 1 and 0. You can call 1 as a man or 0 as a woman, or vice versa. It doesn't matter, whichever way. So you can label them 0, 1, 0, 1 like this. So that is called categorizing the variable. Okay. Here we use the number only to categorize the phenomenon. Otherwise, 0 and 1 doesn't show that something is bad or something is good. Not like that, but they are just symbols of the phenomenon. Okay. So in my case, in this, because this is very, I won't say fake, but fictitious data. So here I categorize the companies as the one who is innovative, I call it 1, and the one who is not innovative, I call it 0. So what I'm trying to say is that even the word innovativeness can be measured by many ways. Okay. Yeah. So then what we do after we have these variables and different colors, because I like to put them in different colors because it's easy for me when I deal with a lot of data, 30 plus variables and having 1,000 plus observations, then your spreadsheet would look scary. But if you do some indexing, like we do in the library, which book is where in certain, so I index them with a color. It's easy to recognize. All right, so now we take the copy, we copy the data, and we have about 500 observations. I don't know how many, but
Control A.
yeah. Oh, I went too far, yeah. Control A, yeah. So does it select the whole data? Oh, good. And then I copy. Well, that could be also Control C. But okay, and then we go to the first cell. And paste, I would say paste with the variable names. Why paste with the variable names? Then you don't have to type them again. Okay, so always paste the data with the variable names. If you only click paste, the upper one, then it could be possible that you have to type them again, and that would be time wasting and very annoying. So paste with variable names. So now you see that the variables are pasted and their names also exist. Are we all at the same level? Okay, I can wait, no worries. It's very important for you to use chat and explain. We have an army of three commandos who would keep an eye that you don't miss out anything.
Do the same step by importing the data.
You can, of course you can. Of course you can.
Sure.
As some of you had the problem in pasting the data, and you use the this control V function. Now the problem is that you have to do some additional work, and your additional work is that you need to, if you stop sharing the screen with me, yep. With you, the problem would be that okay. With you, the problem would be that you have to type in these names in the variable view. You can see here that with me or with many other people, the name of the variable in the variable view is typed automatically. But because you had a problem and you have to use control V function, so therefore you need to type in these names here. And when you start typing these names, they would also appear here. So instead of variable 1, there would be some name, variable 2, there would be a name. But then you have to delete your first row because you can't have the alphabets in the main data. You have to delete those alphabets. And then you have to type the names of the variable here. And then it would work. Okay? Yeah. All right. Then now this is your data, and you can see all the variables are typed in here, and then you have the variable view. The variable could be numeric or string variable, but generally we prefer in your case, most likely it would be the numeric variable. You know, we rarely use the non-numeric. String variable are always problematic because here we use some special signs. And I don't think that in your thesis you would ever need any string variable. Most likely you will be having I would say 99.999% you will be using the numeric variable. But when you, and by the way, if it is not numeric, let's say, if it is saying, hey, it's a string, it comes like this, but don't worry. Go to these 3 dots and change the shape and the format of your variable. So here you can choose what type of nature your variable you want to have. So if by mistake it comes to be scientific or dollar or string or whatever, you can change them back to numeric. But one suggestion I would like to give you, that sometime and rather very often in the quantitative research, especially when you talk about the stock return, market return, your variable can be very small, like 0.0003, 0.000389. If you have very few decimal places, if your decimal places are very few, then that variable would disappear. They all will be zeros. Are you with me? So make sure that you decide how many decimal places you should take. Once again, I follow a bit cautious approach. I normally take 3, 4, 5, at least 4 to 5 decimal places. I know it's a bit annoying, but it's safe. So for the very small variables, I often take minimum 4 to 5 decimal places. You can't take too many decimal places, because if you take more than 7, then there would be dialog box saying that, hey, it's not possible. So maybe 5 is enough, because then even the small variable would appear, and that's what we want. Because if all the variables are decimal 0003 at 9, decimal blah 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 2 3 4, then you will lose their significance if there are few decimal places. So make sure that be generous in choosing decimal places. The default setting is 2 decimal places, but honestly, I don't know how to change the default setting, but I would prefer changing them, because this operation only happens maybe once in your whole analysis. So okay, and now you can see that, look, there are more decimal places now. You can see that even though it was 0.06, but now it's 3 more decimal places. That's what we want, just to avoid the elimination of very small numbers. Now this is how our layout appear to be. And I think now we are ready to analyze the data. And by the way, you can save your file in the SPSS format. So if you want, you can save it and it would be saved. So next time when you come back to the same database, you don't have to copy and paste everything. It will be there already. So you can save it. So that is very nice function. All right, now we go to, yep. Okay, all right. So in that's a good point. We wait for 5 minutes, and once those people who are typing the names of the variables, and by the way, because it's only an exercise, you don't have to type the full name. So you can do some coding or some short form as well. But we wait for you for 5 minutes. Okay, so we carry on our life. The first type of analysis that we will be doing today is called, actually why I'm doing it, is called descriptive analysis. Descriptive. So if you want, I can type it somewhere. It's called descriptive analysis. And the descriptive analysis is like descriptive. No, I deliberately chose this one. I know I can choose text also, but I choose to do like this. Descriptive analysis include mean, basically, median, mode, and then generally we have 3 more, or maybe there are many, but we can take the maximum value of the variable, the minimum value of the variable, range is the difference between minimum and maximum, and then we also have the standard deviation. I hope in the financial management course I explained you what is standard deviation. Yeah. And sometimes we have 2 more called skewness and kurtosis. Don't worry about too much. Skewness and kurtosis are showing that how unequal your data is distributed. So those people who do research in the field of economics, especially about the income and wealth inequalities or the welfare inequalities, wherever the word inequality comes, then I think the skewness and kurtosis really help you. But I don't use it. It doesn't make any sense to me in the financial markets or in the finance in general. Okay, so generally I use, for me, descriptive statistics are including mean, median, sometime mode, max, minimum, range, and standard deviation. The question is, what is descriptive statistics? Descriptive statistics are only showcasing the data. They are the first encounter that how your data look like, but you cannot draw any conclusions based on that. I mean, if you want to conclude something, that how much the company stock performance is related to NASDAQ return, and your analysis is only mean, median, mode, that is unacceptable. Of course, you can compare the average return of your company with the average return of NASDAQ index. But you can't really conclude if you want to make some in-depth analysis. In consultancy, it works. I mean, for example, if you're a consultant and somebody comes to you and he or she says, I want to invest in Apple. Can you give some comparison between the Apple and the other competitors or the NASDAQ market in general? Well, in that case, you can find the average return of the company and the competitors and the index and the standard deviation, which means risk. You know, all these things you have done in financial management course. But if you are a researcher, you are studying 200 companies for 5 years. So you have 200 plus times 5, 1,000 cells, not cells, rather 1,000 rows you have. Then mean, median, they're not really helping you to make any conclusion. So then we really need the cause and effect inferential analysis. Descriptive analysis only gives you a first, like a bird eye view, you know, the first point of encounter with the data. So that is why we calculate them, because we want to see that, hey, how does it look like, by the way? So we are curious. After all, we have so many rows. Even in this exercise, we have about 500 rows and we have, I think, 20 something variables. So we want to see how our data looks like. Why not? Mean, I hope you know what is mean. Mean is very mean, actually. Mean is the normal average, what is called, like 3 plus 4 plus 5, and the mean is 3. Yeah. So if I give you 3, 4, 5, what is the mean? 4, because 3 plus 4 plus 5 divided by 3 observations. But mean has a problem. Mean has a problem. That's why I call it very mean. That if you have the extreme numbers, they can destroy the looks of the data. Imagine we have 3, 40, and 5. And find the average. It'll be 45 plus 3, 48 divided by 3, 16. So the mean would be 16, yeah? Look, 16 belongs to no number. 16 is far, far away from 3. 16 is extremely far away from 40. 16 is extremely far away from 5. Why do we find the mean? We want one value which gives some idea about the entire variable. And here, 16 tells nothing, because 16 is not close to any other value, by the way. So therefore, mean can be a problem. But if I have median, for example, if I find, for instance, median is the value which does not consider the value of the variable, but it considers the position of the variable. You with me? It does not consider the value of the variable, but the position. Just see, we have variable 3, 4, and 5. Which number come in the right middle when you arrange data in the ascending or descending order? Which variable comes in the middle? 50%. Who comes? 4. Now imagine I make it 50 or 500 or 5,000. Your median would still be 4 because it comes in the middle. Am I right? So what does it mean? It means that the extreme values are less affecting the median. So we take the position rather than the size of the variable. The other one is mode. Mode is something which comes more frequently. So imagine that your data includes 3, 3, 6, 9, 9, 3, 12, 6, 6, 6. So then the mode would be that number which comes most frequently. So you can say 3 comes 3 times, 9 comes 2 times, 12 comes once, but 6 comes 4 times. So the one which comes most frequently is the most, representative of the data. So then we say that the average is 6. So then the average is represented by mode. Mode, something occurs more frequently. Okay. And the range is very simple. But first you need to know the maximum. So for example, we have the data 3, 4, 6, 15. Then the max is 15. The minimum is 3. And the range is max minus min 12. So these are some customary things. In many cases, I would say that descriptive statistics in many ways are very, how to say, they're customary in nature. So they don't have much. But please tell me something. I assume that all of you have studied or are studying financial management course. And then there you must have done or doing standard deviation, or you don't know. Remember last couple of lectures, we calculated the firm risk, total risk of the company, and we calculated the standard deviation. And I gave you example of those football clubs, which score even the same number of goals. The average is same, but some are very predictable. They score almost same number of goals in every match. But the others are sometimes they're playing very good, sometimes they play very bad. And then, so the data which is going very smoothly, very consistently has less standard deviation. And those which is very zigzag, very ups and downs, that has low predictability. And that is shown by higher standard deviation. So I will skip it, this thing. But anyways, we come back to the spreadsheet. And if you can't see it, let me know. You see everything now on your screens? Yeah. Now we start doing. All right. Okay. So now I share my screen. And is it visible now? Not even now?
Yeah.
Okay. Okay. So let's do the first thing. This analyze link is the most important link that you'll be using. So what we do now, first analyze. And here we have descriptive statistics. Can you see it? It's very important that we all go together. So I start with this, analyze descriptive statistics. You can use either frequencies or descriptive, it doesn't matter. I choose frequencies, let's say. And then you see that there's an empty space here. This is I always call it football pitch. And here there are players in the dugout. So we decide which player will play. So from dugout, I bring free cash flow, total revenue. Generally, when it comes to mean, median, mode, we prefer the absolute values, not those modified numbers. So I prefer the total revenue, return on capital employed, annualized firm. Even if you want to choose all of them, no problem. That's not a big deal. Annualized, the FTSE return, FTSE, the index we use in London Stock Exchange. We have the market capitalization. We have the price to earning ratio. Then the board size, average education of the board members, average experience of the board members, debt to equity ratio, innovativeness. That's it. And then from here, you can pick up statistics. Okay, so we can pick up statistics here. We can take mean, median, mode. There's no need to have sum, that's absolutely unwanted. Quartiles, we don't need. Percentiles, we don't need. Then I would say I would take standard deviation. Variance, I won't take because variance basically is the square of standard deviation. So what's the point? And then I take maximum, the minimum, and the range. So I can do all the shopping by myself. Now, this is very important that you all are here. So all of us, we should be together here. If you want, I can do this function once again. Okay, so let's cancel it for the time being. Let's even cancel this one. We have the data. Go to analyze. Yeah, all good? Then descriptive statistics. And when you go descriptive, you see opposite frequencies here. Click frequencies. And then this is the dugout. Okay, so we will decide which variable to go this way. Total revenue will go, operating return, return on capital employed. You can even check them by control function. So FTSE return, market cap, and then these variables I need, so I can even by shift function, not control, by shift function, I can select all of them and put them together in the one go. And then click statistics. And now here, you can click mean, median, mode, standard deviation, minimum, maximum, and the range. See, these are the same names which I explained to you before, yeah? So are we all fine? And if we are, then we click continue. And we need nothing else here. And then after you have chosen your favorite statistics, you click OK. And see what? You are getting some outputs. So you can see here, the average free cash flow mean is 56 million. The median of free cash flow based on all the data, how many companies we had, by the way? We had 408 rows. So based on 408 rows, our mean is this, our median is this, mode is this, standard deviation. You can see here a lot of standard deviation in the free cash flow. The maximum number was this much, 2918. The minimum was 0.3 million. And the range is the difference between them, but you don't have to calculate, it will calculate by itself. So you can see that all for each variable which you wanted, your descriptive statistics have been calculated. Yeah. And by the way, if you double click, you can even, you can even save them in, for example, in Excel. So if you want to save it, or maybe you can actually add it, copy paste it. Just a sec. The many things which or actually you can copy. You can also copy as Excel sheet and paste, because ultimately you would like to see your results in the spreadsheet. You with me? So you can do this way, that you can copy as Excel worksheet, the whole thing. And in case you don't see it, remind me. But if I want to open an empty spreadsheet, well, I can go with the same spreadsheet, by the way. So I share screen with you, this spreadsheet. Yeah. And if I make a new, sorry, then I paste. So look, my results are typed automatically in the spreadsheet. So, and then from here, it's very easy to pick up in your thesis. Because it's good that your original source of data is in the spreadsheet, and your output, your results are also in the spreadsheet. It's easy then to move. So then you don't have to, worry about, because all the variables, they are automatically sent or visible in the Excel. So there we are.
How do you do that, like copy from the Excel spreadsheet?
Copy, just press copy. So if you are here,
Oh, yeah. No.
so
But I copied like already the previous one.
look, no, look, Daniel, see, this is your output, okay?
Yeah.
Copy as.
Yeah.
Copy as Excel.
But I already copied this one like in another way. Like that.
I don't know which way you have done, but if you look, then you'll pay attention here.
Yeah, I've done the same.
Look, now this line, boundary line comes, gray line, then click right. Within the boundary line, then it says copy as Excel worksheet, and then paste it in the spreadsheet. Okay. All right. So this is the first encounter. You guys can even do the copy and paste by selecting as well. Even that works very well. So you can actually, so for example, you can do this way. Let me try that. If it doesn't work, you click double time maybe, and then this type of thing appears. And from here, maybe you can.
And it's based like a text, but they have to select that.
Yeah.
It should be pasted as a table.
As a table, yeah.
As a table. So
yeah.
They can do is export. They can
or export.
Yeah.
That is also possible. Let's export. And then Okay.
Okay, I hope you change the decimal value, like maybe 5. Here's the data. No, new data file.
So there are various types of analysis, but in the thesis, the certain bare minimum analysis which you need to do is the descriptive, correlational, and regression. These are something which is common to almost everybody. Okay, so then we move to the next one, and we go to the correlational analysis. So what we do here, once again, we will only go to the analyze thing. Analyze, and here you can see correlate. Yeah, let's go together. Once again, analyze, correlate, yeah, and bivariate. So I keep it for some time. Analyze, correlate, bivariate. Why we call it bivariate? Because you are finding correlation of 2 variables at a time. Okay, so we click bivariate, and then once again you have a dugout thing, and in the dugout you have the variables. So let's choose them. Total revenue, for example, natural log. Well, we can choose whatever I want. Return on capital employed, annualized firm stock return. And then we have the market, annualized market, the index FTSE return, market capitalization, then price to earning ratio, and then we take all these control variables together.
Wait for now. It takes time to find the variable.
Sure. Yeah. So after we have these variables, by default, the correlation coefficient is Carl Pearson's correlation. There are 3 types of correlation analysis. The one is the Spearman's rank correlation. We don't need it. Kendall's correlation, we don't need it. Carl Pearson's coefficient of correlation is the most commonly used, and it's a default setting. And two-tailed test, because we want to test on 2 tails. You know, have you seen the normal distribution curve like this? Have you? Please tell me if you have seen this type of. Anytime, anywhere in your life. So we take 2 tails. 2 tails means there's one central right tail and left tail. So that makes it 2-tailed. So we stick with the 2 tails and Carl Pearson. Correlation, significance. Options is anything special? Nah, it's fine. Continue. And then click OK. And then see what you go to a new output. And here you can see that the correlation coefficients. Okay. Now, what I want you, have a look at this output of correlation. And please make some observations. Do you find, is it understandable? Doesn't make sense? If it is not understandable, I can explain it to you, but I can at least, before I give you this job to do by yourself, I can explain the correlation. The correlation is basically, I can use the whiteboard in case you don't see it, let me know. Correlation statistics indicates the degree and direction of association between two variables at a time. For example, what is the association between amount of advertisement spendings and sales revenue? What is the association between education and crime rate in the city? So when you want to find some association between two variables at a time, you can find for more than two, but at a given time, at a given point of time, we only focus on two variables. So two variables, what is their degree and direction? Please be careful. I carefully use the word degree and direction. By degree means how much are they correlated? And by direction means are they negative or positively correlated? When you make your hypotheses are your assumptions before you actually analyze. I would assume that normally it happens that when you are spending on advertisement, what do you expect to be in the sales revenue? What do you expect? Increase. So it means that when your advertisement expenditure goes up, your sales is expected to go up. When both variables X and Y are expected to rise together, or if fall, but again together, then their correlation, symbolized by sign R, and in the subscript XY, is considered to be positive. If two variables who rise together or fall together, then they are expected to follow a positive association. But then if you look at the second example, what is the association between the education, let's call it education X, and the crime rate Y? When education facilities go up in a city, what do you think about the crime rate? Should it, by common sense, should it also rise or fall? The crime rate should go down. On the other hand, if the spending on education goes down, then you expect the crime rate to go up. It means that here, the relationship seems to be like that. That if one variable goes up, the other goes down. And when the one variable goes down, the other goes up. In that case, the correlation between the two variables is labeled as negative correlation. Does it make sense? Then the question is, if this is the direction, what is the degree? What is the degree of correlation? In that case, we need to go to the next thing. Generally, when you draw X and Y variable, and if they are falling, all the variable you plot, they're falling exactly on the straight line, no variable is no deviation, or they are falling like this. So we have X, Y. The relationship is negative, but no variable is going right or left. They all are falling on the same line. In this case, the correlation is called perfect. Perfect correlation. And what is a sign of perfect correlation? The sign of the perfect correlation is R is equal to 1 and R is equal to -1 in this case. Yeah. Nothing can be more perfect than perfect, right? So I can make a conclusion that your correlation between two variables, it can be maximum equal to +1 and it would be minimum equal to -1. Does it make sense? If by chance you are making the calculation with hand or using calculator on a piece of paper, and it happens that the correlation is actually more than 1 on either side, yeah, you can check by yourself that, this is the wrong answer. We have done some mistake. So it has to lie between +1 and -1. But this is opposite. This is not the same way as regression. Regression can be anything basically, but correlation has to be max +1 and the min -1. The least is -1, the maximum is +1. Now, see, remember this picture? Actually, I can do here only. I don't have to draw time and again. If I, where is the eraser? Yeah, it's here, yeah. So if I erase it, and if I also erase here, and I can erase here also. And here too, we don't need this. If the correlation, when you draw, is like this, but now you see some deviation. I mean, some numbers are scattered a little bit on both sides. I hope you can see, not all the points are lying on the straight line. There is some deviation. Yeah, but generally on the average, you can still draw a upward going line or the downward going line, but some deviation on both sides exist. This is called high correlation. Remember, high is not bad, but it's worse than perfect. In the previous example, I used the phrase perfect. Why I use the word perfect? Because there was no dot around the line, but here there's a dot. So it means some numbers are a little bit, but the gap is not too big. In this case, if the correlation is positive, then the correlation between two variables x, y is definitely less than 1, but I would say it's still more than, I would say 0.7 at least, or 75. We differ in our opinion, but correlation is somewhat between 0.75 and 1. And again, you can understand both sides. So in that case, it would be minus 0.75 and -1. Yeah. So this is high correlation. And if this deviation goes even more, sorry, my apologies. So if the deviation, the more points going around and this deviation is going up, by the way, you don't have to do it by yourself because Excel and the SPSS takes care, but I'm giving you a theoretical viewpoint. The deviation is larger than before. In that case, the correlation is called low correlation. And sorry. It's called moderate correlation, the medium correlation. I skipped one actually. It's called medium or moderate correlation. Medium or moderate. And the sign of the moderate or the medium correlation is that the value of the R is between 0.75 and between 0.25. And in case your correlation is even below 0.25, in that case, this deviation would even increase more. You know, it will be getting more and more scattered. In that case, the correlation is called low correlation. Low, L-O-W. And as the deviation becomes larger, even larger, and you can't really conclude that, hey, what is this? It's like a circle. Now, if it is a circle, I'm just drawing very quickly. If you see that the variables look like this, and when you want to form them in some structure, it looks like a circle, then you can't conclude anything. Because when it's a circle, it can be downward, it can be upward in any direction. Then you say no correlation at all. You can't establish any correlation. And that is where the correlation value is 0. So remember, 0 plus 1 minus 1. Plus 1 plus would show that the correlation, the line is at least going up. Minus would show that the line is going down. But how much, how strong the line is, how strong is the bondage? When the bond is very strong, then nobody goes away, no difference of opinion, if I can say so. So, but if the points are going too much here and there, then the grip of the line is loosening, and then the correlation reduces from perfect to high, high to medium, and medium to low, and low to no. So this is how the correlation is interpreted. But as I said, this information, this knowledge is only for the sake of your understanding. In the real life, you don't have to worry about it, because Excel and the SPSS or the other softwares, they would be very smart enough to look after you. Right? All good? Okay. We take a short break of 10 minutes, and then we come back to regression, but not yet. You still have to do one job. And that job is that look at the correlation statistics and bring to my notice what you observe in that. Because I remember the whole thing started that I wanted you to observe your correlation output. And if I can share that screen with you, it's, wait a sec. If I share the screen, it should be this one, the output of correlation findings. Have a look at this, and meantime, if you want, you can also have a coffee break quick. So we come back in 10 minutes, 10-15 max. So, all right, so we got some observations about correlation coefficients. So, okay. So you can see some observations about correlation. You find that there is a one matrix 1, 1, 1, 1 diagonal, because that is the correlation of the variable with itself. So for example, you can see that the operating profit is on the horizontal axis, and operating profit is also here. So there is the correlation of a variable with itself will always be 1. So it goes without saying. But importantly, if you look at this, for example, 0.306, the correlation between the operating profit return and the return on capital employed is about 30%, 0.306. And guess what? There is a level of significance here. The level of significance is 0. 0 significance. And when there is a level of significance 0, you can see there are 2 stars appearing here. So you can see that, and you must notice that there are some numbers which are having some asterisk on top. Sometimes 1, sometimes 2. Here there are 2. Here there are 2. Here is a 1. Now what does it show? It shows that not all the correlations are significant. Then the question is, who is significant? What is meant by significant? Now I need to take you a little bit away to the world of whiteboard. We have a saying that a person is innocent until proved guilty. And the level of significance shows basically that how much doubt you have in whether the person is guilty or innocent. And we know that if there's a doubt, we always give benefit of doubt. If there's a doubt in the investigation, you always give doubt to the suspect. I mean, you never hang somebody out of suspicion. But if the person is considered to be the murderer or a criminal, and if there is a not 100% doubt, 100% proof that this person has committed the crime, if it is only 100% proof, only then you give the punishment. Otherwise, you let off the person. So you never kill a person by or punish a person by the doubt. But if there's a doubt, you rather give the favor. This doubtfulness is expressed by the level of significance. For example, usually we in SPSS or in the usual econometric analysis, we used by default there are 3 levels: 5% and 1%. But I have no problem with even 10%, 5%. And 1%. And let me call it level of significance, level of significance. Once I give you example, I think then it'll be better to understand. And then parallel to it, I can write level of confidence. Level of confidence. I don't give the example of a murder now, because then I have to be 100% sure. Let's say you guys are my police inspectors and I'm your super cop. And you come with the report that there is a suspicion that in this part of the city, there are some drugs peddlers. And you know that, hey, we think that these people are the drug peddlers. They are selling drugs. And you come with a detailed report, and then I ask you one thing. Do you think that your report has more than 10% of error? How sure are you, Fernanda, in your investigation? And you say, Shab, I think about 85% I'm sure that my report is correct. How much? 85% or 80%. That's even up to 89%. When you say I'm sure 89%, it means that the level of doubt is 11%. So the level of confidence is 89%. It means level of doubt is 11%. In econometric analysis, any doubt more than 10% is unacceptable. The result is there, but we don't accept it because there is a doubt that there is some sampling fluctuation, some kind of randomness, which has caused this error. So in statistics, whenever you see the significance level more than 10%, never accept that. That, of course, there'll be some value, but that value is not acceptable, right? So it means that our level of confidence should be at least 90%. Of course, lesser the level of doubt. In other words, lesser the level of significance. More the merrier. More will be the level of confidence. If somebody comes, if Yane comes and he says, you know what, I think I have 5% doubt in my report, and say it means you're 95% confident. about your invest. Yes, I am. Okay, accept it. Let's make a raid. Let's catch the suspects and start investigation. And if somebody says, you know what, I'm 1% or 0% doubtful, it means I'm nearly 100% confident that my investigation is true, then definitely we have to take some immediate measures. But if you say that my level of doubt is 12%, 11%, more than 10% basically, then those results do exist, but we don't accept them. We don't have enough confidence to accept it. Remember one thing. To prove something, one evidence may not be enough. But to disprove something, one evidence is enough. Make sense? The same thing, the same logic applies here. Because if you want to prove that investigation is true, then the level of confidence has to be very high, at least 90% and more. And that is only possible if your level of significance, or let's call it a non-academic word, if your level of doubt is your level of doubt is 10% or below, at least I don't throw your investigation in the bin. And if your level of doubt is going so small that it's nearly 1% or 0%, then of course I have to accept your investigation. Make sense? Now let's go back to the, where is the
really good example?
Thank you so much. I like these kind of criminal type of examples. Maybe I have read James Hadley Chase a lot in my life. Maybe that is a reason.
Yeah, that's so clear. I mean,
so here you see this 0.306, and it has 2 stars. Can you see that? And see what this star means. My fault, I didn't make a correction up to 10%, and by default, you can see that there is a level of significance at 1% and 5%. Can you see that? It means that SPSS is stricter than me. SPSS say that, hey, I don't accept any doubt if it is more than 5%. So it means that your level of confidence has to be 95% minimum. Maximum it can be 99% or 100%. So it means the minimum limit is 95% of confidence, and the maximum doubt, what I use the word, what was the word? Sorry? Yeah, doubt. The maximum doubt allowed is 5%. And you can see here that the correlation between board size and the operating profit is 0.16 here. It means that when the board size is bigger, the operating profit is more or less. More. Look at the sign. The sign is plus. When the sign is plus, both variables go together up or go down. So I can say that when the board size goes up, there is a operating profit is more by, and this association is 17.6%. And this I can say with nearly 100% of confidence. So there's a strong evidence that there is a positive correlation between the board size and operating profit return. So it's nearly 100% confidence. So I can say with what can be more than 100%? Nothing. So I can say that it's almost an eternal truth in my investigation that board size and the operating profit are positively correlated. The company with the larger boards have higher profits, and the companies with the smaller boards have lesser profits. And then see what? Look at this, price to maybe some other variable where there's only 1 star. Here, market cap, look at that, market cap. And who's the first variable? Free cash flow. Look at that. Can you see there's a minus sign here? It means what? The companies who have bigger share market presence in the stock market, their free cash flow is small. And the companies which are smaller in the stock market, their free cash flow is more. It means here two variables are going opposite. And how do you know it? Because the sign is negative. And look at the tops. Are there 1 star or 2 star? How many stars it has? 1. And what is the meaning of 1 star? Just to refreshen up. 1 star means there is only 5% doubt allowed. It means maximum you are 95% sure, not 99% this time, 95%. So you can say that I'm 95% confident that small companies, they have better cash flow, better resources. And the big companies have kind of not so impressive free cash flow growth possibilities. So you concluded, almost concluded that the small companies, they have the better resources to grow in the future. And the big companies have the fewer resources to grow in the future. And I can say this thing with no more than 95% confidence, or my maximum doubt is 5%. So this is how you make interpretation based on that. And look, for example, here, the correlation between debt to equity ratio, D to E, remember this point 30, and operating profit return. Normally, we expect that how you're financed, debt or equity, it would reflect on your company's performance. And when we do the analysis, we find that after all, there is some number, 0.030. But guess what? The level of significance is how much? 55%, 55% doubt. Can you see here 0.55? There's a 55% doubt. Who will accept a report or a result with 55% doubt? We don't accept more than 10%, remember. And in this case, by default, the correlation says 5%. Okay, we can accept up to 10%, but 55%, no way. So even though there is some value existing, 0.03, but we will not accept it. And then we will write that there is in the literature, when you start writing your findings, the literature states that the companies which are financed by more debt than equity comparatively can have lower operating profit, but our findings does not prove it. Look, you might have studied in your lit review that there is some relationship between the debt to equity ratio and the company's performance, but your empirics do not prove it, or you don't have enough confidence to back up your claim. And likewise, so this is the way we make interpretation of this. Okay, any question, doubt about the level of significance? Remember, in simple plain words, in a very non-econometric, non-academic way, that the level of significance is the level of doubt which is permissible. Basically, it shows that how much doubt, how much benefit of doubt you want to give. If you want to take the level of significance 10%, it means you are willing to give benefit of doubt to the extent of 10%. And lower the benefit of doubt you give, the doubt you accept, more rigorous, more acceptable your results would be. So this is how we do about correlation. Questions, comments? So unfortunately, we don't have much time today. So, but the good news is that now you know how to move the data from Excel to the SPSS workspace. and then how to change the looks of the variable. It should be numeric, and the decimal you change, and then we know some more basic things. So now you know correlation. My only suggestion to you is that if we really want to make our next session more efficient, at least know some very basics of regression. So come prepared, read at least 2 or 3 pages of a topic called regression. Regression is not very different from correlation. The only thing is that in correlation, we don't investigate who is cause and who is effect. But in regression, we not only find the association between 2 variables, but we also determine who is cause and who is effect. Whether advertisement is leading to more sales, or whether more sales revenue earned make you spend more money on advertisement, or vice versa. So this is what we will do. But what I'm going to do is I need to save this file, and I call it SPSS workshop session.
Shab, sorry, can I ask the next quick question?
Yes, go ahead.
If I see like at the table, I see, for example, in-person correlation numbers with the numbers with 2 stars and 1 star. As you said, it is supposed to be 5 and 1% relatively. And but if you will see like at the significance detailed, the one like number below, it's like 0, 0, 0. It's not showing that that's like 5% or 1%.
If something if you're confident 95%, and then you're confident 99%, which one is better even?
When I'm confident 95%, I guess.
95 or 99?
99.
Okay. So if there is a 0, 0, 0, 0, it means you're 100% confident that your result is fine.
Oh, okay. Okay.
Yeah. For example, look at this one where my cursor is. Can you guys have a look at this, please? Something opposite to market cap. It's 4.6. And we accept 5 or below, do we? This is 4.6. So it's fine. But I will not put it, I will not put any star. Sorry, this is not a significance. This is something else. Sorry, my fault. But look at this one, for example, 6.2.
That means 6%.
Yeah, 6%. Generally, as I said, that I didn't give the command to SPSS, but normally we accept up to 10% significance or below, 10% or below. This is 6.2, right? So you can accept it, even though there's no star on it. It's a good example. Even though there is no star on top of it, but because the level of significance is 6%, and as I said before, that we are okay with 10% doubt or below. So 6.2 is below 10. So I would accept it. It's fine. Make sense?
Yeah, got it. Got it. Yeah, that's that means that data is relevant. Yeah, I got it.
Yeah, yeah. It means there is the relationship between annualized market return and the operating profit return is significant. Look here, the variable is the sign of the value of the correlation is, even though it's very less, very less, but still it's significant. Okay. The question is not that they are more correlated or low correlated. The question is that, is their correlation meaningful? And the meaningfulness is reflected through the level of significance. If it was, for example, 0.112, then I would not accept it, because that is 11.2%, and above 10, we don't accept. So make sure that you have a look at the level of significance and then make a decision based on that.
Understood. Thank you.
Can we somehow filter the correlation which is lower than like from 0 to 1? It's like quite slight correlation.
Mhm.
Can we somehow like filter it?
What do you mean by filter it?
I mean, like this super slight correlation can we somehow delete from the table?
Look, when you have many variables, then the individual pairs correlation can be small. But the question is that even though it's small, is it significant? So if I'm a researcher, I would rather not worry too much about the amount of correlation. But for me, it's more important that is it positive or negative? And number two, is it significant or non-significant? You can do whatever you want. But what I'm trying to say, I don't want to say something which I have to back up. I want to use those sentences which could be understood by everybody, because then I have to explain what do you mean by filter. Okay. I don't want to go in that discussion. We can talk one-to-one and then I can understand better what you mean by filter and I can explain it to you. But generically, I would say that any correlation, I will not bother about the value too much. What I would care is positive, negative, and before even looking at positive, negative, I would look if the correlation is significant or non-significant. Anything above 0.100, unacceptable. Anything 0.100 significance and below is acceptable. As simple as that. I keep it very simple and stupid so that it's easy to understand. Okay, so remember this thing, the level of significance which you understood today is very important because in the regression, we will also use this level of significance and the same level we shall use. So it basically, our regression, when we meet next week, will take only 1 hour. And then in the remaining time, we will do some additional analysis. I plan to do chi-square. If the time allow, we can also use the factor analysis. And let's see how far we go. But even if you guys understand up to regression, but thoroughly, I would consider it as a success. But let's see how we go about next week. But as I said, to make my life easy and to make me explain you more, I would recommend you that when you come next week, have some reading, some basic reading of regression. What is regression? Why we do it? What is the purpose? What does it show? Just those things. And that, believe me, that will save a lot of time next week. So thank you very much. And we'll catch up next week. I hope you got some new information in this session and see you next week.
Thank you.
Thank you.
Thank
Bye.
you so much. See you next week.